Hello, friends. Good evening. This is Vinayak from VB Education, and today we'll start with Introduction to Bookkeeping and Accountancy, Class 11 Maharashtra State Board syllabus. Now, before we start with bookkeeping, first we'll try to understand what do you mean by a transaction. Transaction is exchange of goods and services between two person or parties for money or money worth. Now, what do you mean by money or money worth? Now towards right hand side you can see non-monetary transactions. Under non-monetary transactions we have barter transactions where a person is exchanging some goods with in return to fish. So when the money is not involved or the cash is not involved, the transaction is a barter transaction. On the contrary, when money or cash is involved, the transaction is monetary transaction. Now monetary transactions can be of two types. One is cash transaction and other is credit transaction. Now, in case of cash transaction, the cash is paid at the time of purchase. And in case of credit transaction, the cash is paid not at the time of purchase but sometime in future. For example, goods will be purchased today, but the payment is due 90 days from the purchase. That is after 3 months. So this is a normal practice in industry. Fine. Let's move on to the next slide. What is bookkeeping? Bookkeeping means recording of business transactions in the book of accounts in a systematic way. Now, what do you understand by systematic? Systematic is in the sense chronological order, that is in a timely manner. So what all transactions happen first will be recorded first. So suppose today is 1st of April 2020 and there is some transaction taking place. So that transaction will be recorded, and any other transaction which will happen after 1st of April, that is maybe 4th April, 10th April, 6th April, that will be recorded after 1st of April and so on. Followed? Okay. Now this transaction management, it helps you to manage your day to day business activities, and in the end of the year it also helps you to file your taxes and to exactly understand where your business stands or what is the position of your business in terms of profit. So how does this recording of business transaction takes place? Now the first and the foremost recording of business transaction is done in a journal. Jour means a day in French. Journal means daily record. So transactions are recorded in a chronological order, that is a timely order. On the right hand side you can see a tabular form where there are various transactions which are recorded, and if you see the first column, it is a date column. So the date will be in the ascending order. So first all the dates are in the April month, and later on they are May, June, July, and so on. Once the entries are done in the journal entries, then the entries are posted in a general ledger. Now what do you mean by general ledger? Ledger is a principal book of accounts. It is also called a book of final entry. It is a summarized record which contains all accounts, example asset, liability, capital, revenue, expense, etc. Now, what is a good? Goods is that which is produced, then traded, bought or sold, and then finally consumed. Let's take an example. An XYZ pharmaceutical company is into manufacturing, trading, and sales of tablets, injection, and syringe. Now, all of us, we consume different types of goods in our day to day life. Since morning we get up, we brush our teeth using a toothpaste or a toothbrush, Now this toothpaste or a toothbrush is nothing but a goods. Now these goods are produced in a factory, right? But they are not sold from the factory. The goods are produced in the factory, then they are moved to the warehouse where they are stored. After that, they are moved to different parts of the country from where they can be sold to the end customer who are going to consume the goods. So here in I have given an example of a pharmaceutical company which is manufacturing injections, tablets, syringes. So any such product which the company sells for profit is known as goods. Let's move on to the next slide. Now, this is very important terminology. What is sundry creditor? A person to whom business has to pay for getting goods or services on credit is known as creditor. I'll repeat, a person to whom business has to pay for getting goods or service on credit is known as a creditor. A creditor is a person to whom business owes money. Now, when I say business owes money, means the business has to pay to the creditor. Now, why will the business pay to the creditor? Yes? Can anyone tell me? Yes, correct. So, suppose that XYZ company, which we have considered in the previous slide, it is into production of tablets, right? Now, for producing tablets, what is required is a raw material. The tablets will be produced using, for example, suppose I'm producing a metacin tablet. So, for metacin tablet, the powder required is paracetamol. So, this powder in pharmaceutical company, it is known as API, that is active pharmaceutical ingredient, and this is the raw material for production of tablets. Now, the pharmaceutical company XYZ, it is going to purchase this particular API from some supplier. In return, XYZ will be making payment to the supplier, but the payment is not done immediately in cash. On the contrary, the payment is done in the form of credit. That means the payment will be done after a certain period of time, maybe 1 month or 3 months. So, here in the slide, you can see paracetamol is a raw material, and along with the raw material, you also require packing material for the tablets. So, tablets, when they are produced, they should be packed right into boxes. Their tapes are required, boxes are required, everything else is required. So, that is a packing material. So again, there is a sundry creditor for packing material. So this packing material will be bought by the pharmaceutical company from someone, and that someone is a supplier. So when you are purchasing something from supplier, you need to make the payment to the supplier, right? Yes. So the payment which we owe to the supplier, or payment which the business owes to the supplier or the creditor, is known as credit. Okay. So we owe to the supplier some amount of money which we are going to pay after a period of time. So is that clear? So sundry creditor is nothing but the supplier, the person who supplies goods for our business. And these goods are in the form of raw material, packing material. Okay. Now let's move on to the next slide. Now, sundry debtor. What is a sundry debtor? The XYZ company is producing the tablets. But what it will do with the tablets? It is going to sell out the tablets to someone, right? And who is that someone? That someone is nothing but the retailer or the distributor who will distribute this tablet to the end customer. That means the XYZ company will sell its tablet to someone, and that someone is sundry debtor. A person who has to pay to the business for getting goods or services on credit is known as debtor. A debtor is a person who owes money to the business So when XYZ sell the goods or sell the tablets to someone, that someone will have to make the payment in future to XYZ, and that is future is in say 1 month or 3 months. Okay. So any customer, so customer is a debtor. Any customer is a debtor and it owes money to the business. Customer will purchase the goods from the company and customer will have to make the payment to the company. Correct. Okay. Now let's move on to the next slide. What is bad debts? Okay, if we move on to the previous slide, we have seen sundry debtor. Sundry debtor. Now we are seeing bad debts. Now what is bad debts? Bad debts, as you can see in the picture, customer not paying you, take action. Okay. So there are many fraud customers out there in the market. So any irrecoverable amount from a debtor is known as bad debts. It is a revenue loss to the business. So any customer who does fraud with the company and does not make the payment after receiving of goods, that payment becomes bad debts. So till now we have studied sundry creditor, which is nothing but a supplier, sundry debtor, which is a customer of the company, and bad debts, which is a fraudulent customers who do not make the money, and that money it goes as bad debts. Okay, fine. Let's move on. Now let us try to understand what is expenditure and types of expenditure. Now there are basically three types of expenditure: capital expenditure, revenue expenditure, and deferred expenditure. An amount spent by the business for any consideration received by the business is called expenditure. Now, what is capital expenditure? As you can see from the picture, the building is constructed. So, for the construction of the building, we require some money, right? Money or capital. Yes. So, this fixed money or capital which we invest in our business is known as capital expenditure. Now, what is revenue expenditure? Now, when a business is running, there are various bills which need to be paid by the business. For example, the office rent, electricity bills, the wages of the employees or salary of the employees. These all are revenue expenditure and these will occur every month on month basis. So the capital expenditure on the contrary, it will happen only for a one time, but the revenue expenditure will be happening on regular basis. That is the basic difference between revenue expenditure and capital expenditure. There is one more expenditure, that is deferred expenditure, which is not directly expended. It is not a direct expense. When you are doing an advertisement of the company, right, you are getting benefited by doing the advertisement, but not in the in recent future, but in long term. So that is deferred expenditure. Advertising is a deferred expenditure. Okay, let's move on to the next slide. Now let's try to understand what is accountancy. Accountancy is the practice of recording, classifying, and reporting of business transaction for a business. So just imagine you are owning a business. Now, when you own a business, you have to record the transactions as told earlier. You have to classify it into various different types and you have to do the reporting to the management of such transactions so that the business can run smoothly. The management should exactly know the position of the business, whether the business is in profit or loss making. So, examples of recorded transactions are purchase of goods from sundry creditors, that is supplier. So, whenever you purchase goods from a supplier, you have to record it in a book of accounts. Sale of goods to sundry debtors, that is, whenever there is sale involved, that also needs to be written in the book of accounts. Similarly, what all bank loans are taken by you, That is a part of accountancy. Also, interest on drawings. Now, what is drawings? Drawings will learn in the future slides. Now, what is the basis of accounting? There are mainly three bases of methods of accounting in common usage, namely cash basis, which is followed by doctors, lawyers, chartered accountants, and non profit making organizations. Now, you must have visited a doctor or a lawyer. So, whenever you visit a doctor, do you pay him in a check, or do you say that, okay, I will make the payment after 30 days? No, you make on the spot payment in cash. So, the doctor will record this received payment at the time of receiving the cash. So, it is a cash basis. So, whenever a cash is received, the doctor will log it in his logbook that so and so cash is received from so and so person. So, that is the cash basis. Now, let us try to understand what is accrual basis. Accrual basis is nothing but the credit sales. As we learnt in the previous slides, credit sales is something which is purchased today, but the payment is not done today but in recent future, maybe 1 month or 3 months. For example, when there is a big consignment, when a big company purchases some goods from the supplier, or a customer purchase goods from a big company, okay, the payment is not done on immediate basis in cash. There can be n number of reasons for not making the payment in cash. First reason may be because of the goodwill, that okay, this I know this person, so okay, you can pay me tomorrow or day after tomorrow, or you can pay me, make the payment in 1 month. So why do business entertain such practice? Why it is allowed? It is allowed because there is a large competition in the market. So, if I ask cash for all my transactions, I may lose business. People may go to some other organization or other company, right? So, there is always a window of 30 to 90 days for making the payment. So, that kind of transaction is booked at the time the sale is done or the purchase is done. Are you getting my point? Let's take an example. In our previous slide, XYZ company, okay, sold goods to ABC customer, and now the ABC customer will make the payment after 90 days. Now, when do you think this transaction will be recorded? Will it be recorded the day when the goods are sold, or the day when the payment is received after 90 days? Right. So it is booked in the books of accounts when the goods are sold, and not when the payment is actually received after 90 days. So followed, what is accrual basis? Okay. Now what we have is mixed or hybrid basis, which is a combination of both cash basis and accrual basis. Fine. Let's move on to the next slide. Now, what is the difference between bookkeeping and accountancy? Now, as you can see the picture, the bookkeeping, it is a day-to-day activity, and accountancy is a entire year activity. So accountancy is done once in a year. Bookkeeping is done on a daily basis. Now, the starting point of bookkeeping is journal entries and ledger entries. The starting point for accountancy is journal entries and ledger entries, but the end point is profit and loss and balance sheet. So, definitely, a person who is less educated or has less knowledge, he will be doing the bookkeeping. And person with the high analytical skills, example a manager, he is involved in the accountancy. So bookkeeping is just recording of transactions in the book of accounts, and on the contrary, accountancy is something more analytical, and it requires more analytical skills. Seeing the bookkeeping, the management cannot take any decision. Management cannot take any decision on basis of bookkeeping, but management can take decision on basis of financial reports. So what is the end point of accountancy? It is profit and loss statement and balance sheets. So definitely just by seeing at the balance sheet you can make out whether the company is making profit or it is in loss. Okay, fine. Now let us try to understand what is an asset. You must have heard your friends saying or your parents saying he's a good asset to the company. Now what do you mean by an asset? Your parents own a house, right? So that is their asset. Your parents have a vehicle, car, that is an asset. Cash, it is an asset. So any physical thing or right owned that has a monetary value is called an asset. The ownership of the asset must be with the business. Example: cash, bank, land, goodwill, patents, computers, etc. So, what all cash is in the bank? It is an asset. A land purchase is also an asset. Now, what is goodwill and patents? Okay, first let us try to understand different types of assets. Now, there are two types of assets basically: non current assets and current assets. Non current assets you can also call as fixed assets. Now, do you regularly buy and sell houses or buildings? No. Building is purchased one time in the business, right? Unless and until you are into property sales. So, building is known as a fixed asset. So, whenever a business purchases a building or a car or a vehicle or furniture or a computer, these are all fixed assets. Okay. On the contrary, if the assets are bought on regular basis, for example, cash we have to handle every day in day out. So cash is a current asset. The bank, all the transactions for huge companies, they are through bank. So the bank balance always keeps on changing. So that is a current asset. So here in the slide we can see two types of assets: tangible asset and intangible asset. So asset can be further classified as tangible and intangible. Tangible assets are assets which we can feel or which we can see. For example, plant, land, vehicles, machinery, building, stock, furniture. These are all tangible assets. Intangible assets are goodwill, logo, patent, copyright, trademark, brand name, and own softwares. Now let us take an example of intangible asset, goodwill. Now what is a goodwill? What do you understand by goodwill? Now suppose tomorrow you go to the shopkeeper and you ask for a salt. Now which salt would you ask for? Would you ask a salt for from a XYZ company or Tata? Tata salt. Yes, you'll definitely go for Tata salt. Why? Because Tata is famous. It's been 100 years from now that Tata is selling salt, right? So it has a goodwill in the market. So any company who has a name in the market, that is goodwill, and this goodwill can be sold. So whenever the company sells out, it can also sell out its goodwill. Similarly, the company logo is also an intangible asset. Patents and copyrights, again, it has something to do with, it is like patents or copyrights. Some pharmaceutical companies, they have an R&D department, research and development department. Daily they are finding out new products, and when they launch these new products, they will get a copyright for say 10 years. No one else can produce this tablet for next 10 years. That is copyright. Copyright word you must have heard in movies. So whenever a picture is made, movie is made, you cannot make the videos of the movie and put it on YouTube, right? Why? Because of the copyright. Similarly, trademark, brand name, and own softwares, they also have some definite value. So now do you understand what is an asset? Asset, it is two types: fixed asset or non-current asset, and current asset. Also there are two types: tangible assets and intangible assets. Now comes liability. Now what is a liability? Amount payable by the business to others is known as a liability. Liability is the amount owned by a business which needs to be paid back. Now, in the previous slide, we have heard of sundry creditors. What is the sundry creditor? Sundry creditor is a supplier. The supplier has given us goods on credit. So it is my responsibility, it is the company who has to pay back to the supplier. So supplier, goods purchased from the supplier is nothing but a liability. The company is liable to make the payment for the goods which it has purchased from the supplier. So liability is the amount owned by business which needs to be paid back. It is a debt or amount due from business to others for the benefits received by the business unit. Example: loan taken, creditors, bank overdraft, outstanding expenses, etc. So today, if you are using your credit card, it is a liability because you have to make the payment in future. So what are there are two types of liabilities: current liabilities and fixed liabilities. Current liabilities, example is bank overdraft. What do you mean by bank overdraft? Has anyone heard about bank overdraft? When there is no money in the account, but you can still use, see, this facility is given in current accounts. Businessmen who are using the current account in the banks, they are getting a facility of bank overdraft. Why? Because sometimes there may not be some cash in the account, but they want to urgently make the payments. So bank will provide them some marginal overdraft, say around 5,000, 10,000. So even though there is no money in the bank, the check will be cleared and it will not bounce. So that is bank overdraft. Similarly, creditors, that is supplier, it is a liability. Bills payable. Bills payable and sundry creditor is same thing. Short term debts, advances and deposits received. Outstanding expenses. Now, outstanding expenses. What do you understand by outstanding expenses? At the end of the month, you must be receiving your maintenance bill, your water bill, your telephone bill, your electricity bill. These are all our outstanding expenses. We have to pay these bills next month. So they are the outstanding expenses. They are a current liabilities. Expense till the time it is paid, it is liability. Liability in the sense, in Hindi you can call it udhar. Okay. Now fixed liabilities. What are fixed liabilities? Fixed liability is a type of liability which is payable over a term exceeding 1 year. For example, you have taken a bank loan. Okay. Suppose you have taken 10 lakh rupees loan from the bank and you have to make the payment in next 5 years. So that is a liability. And this liability, it should be booked in the book of accounts. Okay. Now, what are the types of liabilities? Fixed liabilities. One of the major source of funds in the business is fixed liabilities. It may be in the form of capital, secured loans, long-term loans from banks and from financial institutes, etc. Current liabilities. Short-term liabilities payable within a year are called current liabilities. Current liabilities arise in regular current operations of business. These liabilities are not normally secured. Example, creditors, bills payable, etc. Just excuse me. Okay. I was just checking whether the recording was done properly. Okay, so types of liabilities is fixed liability and current liabilities. Let's move on to the next slide. Now, what is capital? Friends, what do you understand by capital? Can anyone tell me? The amount invested into business by the owner is called capital. Very simple, isn't it? If you want to start a business today, you have to invest some amount, and that amount is nothing but the capital. So, the what is the formula for capital? Excess of assets over the liabilities is called as capital. So, capital is equal to assets minus liabilities. So, what all things you own to what all things you owe to the business is capital. So, capital is the liability of the business as this amount is payable by the business enterprise to the owner at the time of closure of the business. What do you understand by this line? Capital is the liability of the business. Yes? Now, friends, first try to understand when a person is starting a business. Suppose tomorrow you are starting a business. You and a business, these are two different financial entities. You cannot say that you are the business. The business belongs to you, yes, definitely. But you are just a part of the business. You are not business. So, business and you are two different financial entities. So, whenever you are investing money in the business, that is capital. So, business owes money to you. Business has to pay back the money to the owners when the business is shut down, right? So, the capital is a liability of a business as this amount is payable by the business enterprise to the owner at the time of closure of the business. Okay. Now, what is working capital formula? It is current assets minus current liabilities. Now, what is drawings? Now, just now I told you that the owner and the business are two different financial entities. Now, at times it happens that the owner wants some money. So, owner will withdraw money or remove money from the business for his own personal use. Just take an example. Suppose there is some corona COVID-19 in his family, the businessman, and he doesn't have much money. So, what he will do? He will withdraw some money from the business for hospitalization expenses. Now, this hospitalization expense is his own personal expense or family expense, and it is not part of a business. So, he has to keep it separate. So, whatever money drawn by the owner from the business, it has to be returned to the business. And such money drawn from the business is known as drawings. So, the amount of cash or value of goods, assets, etc., withdrawn from the business by the owner for personal use is called as drawing. Example, a proprietor pays college fees of his son or pays for medical expenses, mobile bills, etc., for the business, from the business. And these are the personal mobile and personal medical bills, okay? Not the companies. Fine. So, students, that's all for today. Thank you so much. The next session will be soon uploaded. Meanwhile, you can click on the subscribe button and click on the bell icon so that you don't miss the next lecture. Thank you so much and bye.